You can do it. There it is.
Looks
Oh,
promising.
man. Struggle is real. The Fed, everybody, the Fed. Dan Parker's in the house. Right there. My man. Let's break it down. I'm going to break it down for you today. Wish we had better news. I wish there was better news to discuss than what's taking place here, but it is what it is. So we're going to jump right to it. Live in so many places right now. So many Facebook pages, LinkedIn, YouTube, Twitter, Facebook group. I believe there's one of those. And also on Instagram. I've got my Instagram running now live, which I've never done this before. So you can't see anything but me, but you can hear what's going on. All right. So Dan, here's the big deal today. Obviously, Fed hikes rates.
Yeah.
I want to talk about this article. I want to talk about the implications of this, what you're seeing on the ground level, what I'm seeing on the ground level, and then we're going to run through some key data points I think everyone should be paying attention to, not just in real estate, but in financial markets.
There's a lot going on right now. And, I think it's really important to look at all the data points and kind of combine them together for the analysis, along with what is actually happening out there on the streets, which, I've had 4 transactions closed in the last week. There is still activity going on right now.
Nice.
I'm excited to dive into all this coming soon.
Beautiful. Let's do it. All right. And we're live. We're taking questions, comments as well. If you want to drop those even here on the Instagrams, I'll get to it. But if you're on LinkedIn, YouTube, Twitter, or Facebook, just drop a comment. It'll populate right through. Okay. So Fed approves 0.75% hike to rates, taking us to the highest level since 2008. They love mentioning that, by the way. Let me just break this headline down for you real quick. They love being able to mention anything that resembles 2008, the highest since 2008, the lowest since 2008, the greatest, delta since 2008. They love talking about this because it stokes fear and gets them paid. Mm-hmm. Clicks makes them tick, right? So They love saying that. Hints at, this is the thing that was really interesting to me, Dan, hints at a change in policy ahead. Now, I don't know what they were listening to. I don't know what they heard, but what I heard was a man that seemed very committed to getting inflation to 2% and being willing to stay the course. And when he was asked about housing, he was kind of like, oh yeah, just got to work itself out. Huh? I mean, just bananas.
Very interesting.
Right? Then down here, look at one of the key points. However, stocks fell, stocks cratered. We'll show you charts in a second. As Fed Chair Jerome Powell dismissed the idea that the Fed may be pausing soon.
Can you scroll down just a little bit? I think our faces are over it.
Are we in the way?
There we go. There we go.
Dismissed the idea that the Fed may be pausing soon. Dismissed it. He said he expects a discussion at the next meeting or two about slowing the pace of tightening. So that doesn't sound like a change in policy. This is a maybe we'll discuss it later.
Yeah.
That's not really a change in policy ahead necessarily. And if you listen to what he said in the interview afterwards, after the announcement, it was very much, we're committed. This is what we're going to do. We're going to stay the course. We're going to do what it takes. 2% inflation, 2% inflation, 2% inflation. And that was really the whole meat of the message. So for me, what I heard was, let it burn. Let it burn. Whatever it is, it needs to burn. It's a forest fire. It's healthy. Let it burn. We've got to take care of this because, and he even said this, I don't know if he caught this or not, but I was just like, what? He said, it's better for us to overcorrect than undercorrect. Let me repeat that. It's better for us. It makes more logical sense for us to raise rates too far than to not raise them enough. Now, he was asked by a reporter, hey, you must be aware of the lagging effect that these interest rate increases will have on the economy. In other words, we're not going to see the impact for quite some time. So when do you actually pause for a second and just see if it's doing anything or how much it's doing? Mm-hmm. And what he said, yes, we are aware of that. We're paying attention to these different things, but we believe that we're on the right course. And we're going to continue on this course for the time being. So it didn't really provide an answer, which I thought was a great question. Like, well, how do you know? I mean,
yeah, absolutely.
When do you say, hey, that's enough for now? Can we say it's been the most since 2008? Is that enough for us to say, hey, guys, back off for just a second and let's see what's going on? This is, bottom line is this, Dan, the real estate market is suffering because of where mortgage rates are at.
Mm-hmm.
And that's the only issue there. In my experience, and I want your boots on the ground opinion on this, but in my experience, there's lots of people who are interested in real estate. There's lots of people looking at houses. There's lots of people getting pre-approved to buy homes. But when people are getting quoted payments, they're going, wow, that's a lot.
Yeah.
I don't like that. And that's where the rubber meets the road, and you really start to see people fall off a lot once they get to that point. What's your experience been here recently?
Yeah. And and you would know the numbers better than I would, but from rough analysis, like we saw 40% median home price increase here in San Diego in the last 2 years. It went up like crazy. And then at the end of that, we kind of ended at the beginning of this year. And at the beginning of this year, we were right around 3% mortgage interest rate. As of right now, we're, plus 7 to 7.5. You can tell me exactly where we're at. You're talking about, first you have a 40% increase in the home values. Now we have almost a 40 to 50% increase in, or I guess decrease in affordability based on how much more expensive the homes are. That obviously that's going to have a real effect on people. Now, the crazy thing is, like when you actually look at everything, the assumption is, all right, well, home prices are going to come falling down like crazy. And that's not what we're experiencing. That's not what we're seeing. We're not here saying that home prices aren't coming down, because they are definitely coming down a little bit, and they're expected to continue to come down a little bit. But that's mostly driven by demand. We still have a supply problem. We're still only at around 4,000 homes for sale when we need 7,000, 10,000, 15,000 homes for sale. We're not there. And what we're seeing right now is we're seeing this situation where 71% of current homeowners have a mortgage interest rate of 4% or less. Why would they sell their home? They're terrified to sell their home to buy a home at 7.5%. So we're actually seeing this situation where the root cause is inventory. We need more inventory. We need more homes for sale. And it's nowhere near increasing at the rate where we would need it to see a really drastic change in prices.
Yeah, it could be a lot worse, right? If homeowners were lining up to sell their homes, it's not a great market for sellers. It's kind of a market where nobody feels like they're winning. The sellers are having to sell for much less, and buyers are having to even pay higher payments than they would have at higher prices, just a year ago, let's say. I'm going to link to Dan's channel, by the way. He makes much more professional, much cooler looking videos than I do, and is going to lap me subscriber wise here soon. You check it out if you want more information about, San Diego real estate. Just tons of really good stuff in here from Dan. So I'll link that in the description below. And so when I see what's going on with interest rates and how important it is, and by the way, I want to give you this one more key takeaway from the Fed meeting, and particularly in the statement that they made, is that there seems to be, when we were in the height of the market, when the Fed was stimulating everything like crazy, we had tons of demand, rates were at all-time lows, they were willing to stimulate. Now, because the inflation reading is too high in their opinion, they're not willing to stimulate, which shows you, okay, if you're focused just on inflation, that is something that is a dynamic phenomenon. If we look at, for example, the strength of the dollar, the Dixie here, the DXY, and we added this today. So this red arrow, these red arrows are all of the Fed increases. Okay, so that's the sixth one. And each time you see as we move the dollar index up significantly, this reduces anything that's priced in the dollar. So that includes your stocks, your cryptos, oil, whatever, everything that is priced in the dollar goes down when the dollar's going up, or at least that's the pressure that's put on it. And so we've seen the tons of pressure. So when you look at this, you go, well, goodness gracious, what's inflationary about that? That's about the most deflationary chart I've ever seen in my life. So the dynamic elements of inflation are also at play here. And this is more of a global scale. And I think the Fed is focused really just locally or nationally, let's say. and they should be paying a little bit more zoomed out attention, in my opinion. We don't need the Dixie running around at 112. We right around 100 would be fine. And that would make things a lot less contentious in the financial markets. Nonetheless, this is what we have. And unfortunately, mortgage bonds also not responding well today, which is another thing that's very interesting. It's like the upside down that we're in, because when the Fed is raising rates, that's deflationary action that actually should give a short-term boost to bonds. It does not, it has not been doing that. This level right here that I've got marked out with this green line right here, that's our key support level. Okay, that is essentially the neckline for this reverse head and shoulders. That is really the only hope we have. We got this one wick down right here. We could see, another down day like this. But if it were to hold, we were able to see that we had these two shoulders here, we could still be somewhat bullish about bond prices going higher and rates going lower in the near term. As of right now, though, it's not looking great. We have serious rejection off of this 25-day moving average right here. Just simply cannot get through it. We had an extremely bullish candle right here and no follow through. So at the moment, be honest with you, Dan, the outlook for rates not look great. It's not look great.
Yep.
And we finished the day today with conventional rates being in the low sevens. Okay. Right around 7. You can get a little bit less than that if you're putting a big down payment and things like that. But just overall average, low 7s for conventionals, mid 6s for FHA and VA. And for jumbos, you still get some arms. There's still some cool stuff out there, like 10% down jumbos, 5-year arm for 6.75% and stuff like that. But most of what I'm seeing is that people don't want a rate that starts with a 6. I think if we were in the 5s, that would be a total game changer for just the mentality that buyers must have. But I keep seeing the same pattern happening over and over, where people go, they see a home online, they go look at it, they get excited. I tell them what the payment is, and all of a sudden they don't like the house anymore.
Yeah.
And I don't know how that's going to stop unless prices come down a whole bunch or rates come down. Something's got to give here, Dan.
Yeah, it's tough. I mean, as far as what I'm seeing out there, like I can tell you for sure there are fewer buyers out there. But at the same time, anecdotally, out of the last 6 offers I put in, 5 of those went over asking. 3 of them we put an offer in over asking and did not get our offer accepted. And these are all, mostly different buyers. There's 4 different buyers. One of them we got under asking by $70,000, but it was a $1.4 million home. It was on the market for 2 months, and it had $20,000 worth of foundation issues. So, yeah, I mean, it's interesting. It's like, where are these buyers coming from? And it's all different scenarios. One of the big things is there's more cash buyers right now, or I guess the cash buyers have stayed the same, and a lot of the finance buyers have dropped out. Not all of them, because I'm definitely working with some finance buyers right now, and I have been. But yeah, that's just kind of what we're seeing out there.
Yeah, no, you're right. It's a dream scenario for cash buyers, especially if you can find a motivated seller, because there's a very good chance that they don't have offers.
Yeah.
And, that's a perfect situation to be in if you're a cash buyer. I'm hearing about people. I've experienced the same thing. Super interesting, because we've had multiple people in this much lower price points, though, where people are trying to buy places in the 4s or 5s, usually the condo, and there's 4 or 5 offers and we don't get it. I mean, I've had that happen 2 or 3 times in the last couple of weeks, where you're thinking, hey, we're putting in a really good offer here. We're putting in an offer over ask. Oh man, we're going to get this. Nope. So there is definitely still competition out there for the right inventory. But there are a lot of people who are still trying to kind of get yesterday's prices, or, like, how do you list a home in a market like this? Honestly, I mean, where do you price it? You can't price it at the last comp, right? You have to price it under that.
It totally depends on the strategy of the sellers, right? Like, for one, you never want to be in a scenario where the home sits on the market for 3 weeks and then you have to lower the price. You never want that scenario, because here's what happens in the buyer's mind. If you lower the price to where it should have started at, let's just say home prices stay the same, which they're actually kind of going down a little bit right now. But let's say, market value is 800, you list at 850. And then after 3 weeks, you bring it down to 799. The first thought in buyers' minds when they see that 799 is, oh, well, we can probably get that for 750, or we could get that for 700. So, it doesn't really matter that you brought it down to the right price. Now the buyer's mind is, now it's going to be even more of a discount because they're desperate. So
Yeah.
you do need to market it strategically. I think in some of these scenarios, like I have a buyer who's an older lady. She didn't want to have her home on the market very long. There was a lot of stress involved with the selling process. So we started the price a little bit lower than we normally would because we wanted the best price and the best terms to make it really, really easy for her transition. And that's exactly what we got. So there's all sorts of different strategies that it just depends on exactly what your seller strategy is. But yeah, it's never a good idea to price it where it's just going to be sitting for weeks and weeks and weeks.
I'm seeing a lot more auction listings out there right now.
Yeah, there's that
You
too.
notice
For
that?
sure. Those are never fun.
It's just hard to gauge. It's
Yeah.
sometimes buyers will see it and they go, "Oh, this one's only 485," and they're pre-approved for like 500. And you look at it and you go, "That's a $700,000 house."
So, in part of the strategy on this, I don't know if you're aware of this, Derek, but part of the strategy on listing a home like that is because us real estate agents, or a lot of the real estate agents out there, there's somewhere between 25 and 30,000 real estate agents in San Diego County. When we've only had, I think, 1,500 homes sold this last month or something like that. And so there's a lot of agents that aren't doing business or a little bit scared about the drop in the number of transactions. And so some agents, when they get a listing like this and they get an opportunity, they will lower the price well below where it's supposed to be because they're just trying to get buyer leads in. And then when the buyer leads come in and they say, "Oh, you know what? This home actually went for X amount or already sold, but let me show you these other homes that are available." That could be part of a strategy for agents just to get more business, which is obviously not. No one feels good about that. Like, it's a little gross.
I almost like. Do you remember a few years ago where there was like the $1 listings for popping up?
Yeah, that's right.
I appreciate that a little bit more because it's kind of like
Sure.
just telling you, like, listen, bring your best offer.
Yep.
Whereas when you price one that's really should go for 700 for 500, you give a lot of people false hope. It's really sad. It's sad because they'll say, "Okay, what's the max we can offer on this?" I'm like, well, it's not going to be enough. I can tell you that. But there's things going on. The market is interesting right now because we're in a situation where it's definitely not a great market for sellers in comparison to the last year or two.
Yeah.
But if you bought 20 years ago, you're still murdering it. If you bought 10 years ago, you're still murdering it. So it's hard to say it's a bad market for sellers, but it's not the same that it's been.
Yep.
For buyers, it's gotten dramatically better from a negotiation standpoint, from a price standpoint, but it's not gotten better from a payment standpoint. As you alluded to, we began the year January 1st, 3.11% was the average interest rate. Now we're at close to 7% is the average interest rate. So we have a 4% increase in the average interest rate, which is significant. It's very significant. It's much more significant in our market than it is in a market with lower price points, because this is something that scales, right? Like I remember realizing this back in the day when I first started my mortgage career in Missouri, and we would refinance people who had $100,000 loans or $150,000 loans, and sometimes they'd be like, "Oh yeah, I got 11.5%." You're like, "Oh, well, I can get you 7," and you calculate it up and it saves them $28 a month.
Yeah,
it's just not that significant at those lower price points. But when you're talking about 600,000, 700,000, just sort of being the middle ground that we're looking at, 4% is pretty significant. And that's why the 2-1 buy down has been a very popular product lately. Sellers have been willing to pay, and that people have been taking advantage of that. It's lowering payments significantly for people so they can sort of bridge the gap between now and a refi opportunity down the road.
Or
so
the other scenario, like, and sorry to interrupt, but
Yeah.
I was just talking to a client right before we got on this call, and what they're telling me is, Dan, based on where we're at with our job, we can pretty much guarantee in 2 years we're going to be making significantly more because we just got out of college. Now we got some really good jobs, and we should be making more money in 2 years. Or the buyer that their cash flow coming in every month is pretty substantial, but their down payment is, they don't really have a lot for down payment, so they want the opportunity over the next year, 2 years, to build up their bank account. I get hit a lot on my channel of, "Oh, don't just tell people that they can refinance in 2 years because it's not a guarantee." And that's absolutely right. It's not a guarantee. Prices are coming down right now, and they could continue to come down, and that could cause a little bit of a dilemma. And we don't know when rates are going to come back down. But the reality is, it's very, very likely that you can be in that scenario. So always plan for the worst case scenario, but know that this is very, very, very likely that in the next couple of years, you could utilize one of these programs like a 2-1 buy down to really decrease how much money you're spending every single month for the first year. And then again, for the second year, and more than likely, you're going to have an opportunity in the next, 12 to 18 months after that to refinance and be in a better position.
100% agree. Yeah, it's not guaranteed. Nothing is, but very, very likely.
Yeah.
Extremely high likelihood. Lots and lots and lots of macro pressure on interest rates to be lower, both from the government and the Fed. Everybody wants lower rates. Wall Street, everybody. So there is a tremendous amount of inertia moving rates lower. It really takes something like this, just runaway inflation, which is what we've had. We haven't experienced that since, it's been 40 years. Yeah. So plus.
So they were tracking in 81 or something like that.
Yeah, it was the late 70s when it started sticking out. And then I think early 80s is when it was all the numbers that we've been sort of like breaking or touching for the first time since then. So like 40 years, we haven't seen this. It took that to get the Fed, out of the chair and go, okay, all right, we got to do something here. But if it weren't, for something so significant, they would still everyone would want lower rates. Here's the key change in their statement, by the way. All they basically did was change, they changed the rate, and then they said this. The committee anticipates that ongoing increases in the target range, I don't know if you can see this or not, will be appropriate. And here's what changed. In order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In determining the pace. Yes, right? That's the whole focus.
Throw in the ambiguity, just a hint of ambiguity enough so they can do whatever the hell they want.
Yeah, there's nothing definitive here. In determining the pace of future increases in the target range, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, and inflation, and economic and financial developments. Basically saying, hey, we realize it may take some time, but our focus is still on this 2%. So we'll take this into account, that, hey, maybe we don't need to be as tight. Maybe we do. We're going to consider that. And so that's where I think you get a lot of people thinking, oh, it sounds like maybe there's a pivot. And it felt like there should be a pivot. It really did, but there hasn't been one. And then today, when the first thing that happened this morning is bright and early, 8:15 Eastern, the employment report comes out. And, private payrolls were up huge. And I was like, oh gosh, there's no way you're going to see remotely close to a pivot. I mean, there's no way. These numbers would have to be coming in terribly, and they just aren't. The employment numbers aren't coming in bad. The defaults and all the things that people are tracking, they're just not coming in bad enough for the Fed to think that they need to do something. Remember, think about the Fed as like an ER. Like if you're like, hey, I think I might have something, getting wrong with my hip, you don't go to the ER because they'll just be like, come back when it's broken. Like, we don't fix things until they're broken here. And that's kind of like what the Fed is. They're not really going to be interested in fixing something until they can clearly see that it's broken, diagnose it, and then write a prescription for it. And that's kind of how they're going to take all this stuff. So the rental vacancy rate jumped a little bit, which was interesting. I talked to a buddy today who owns a place in Washington, and he said he's having a hard time. He lowered the rent by $500 a month. He's having a hard time getting somebody in there. And that's the first I've heard of that.
Yeah.
So, there's definitely some interesting things out there. There's one. Oh, I wanted to show this too, Dan, just for people who are tracking financial markets. So this is the S&P right here. Okay. And this is really important. I've been talking about this for some time now. All right. So we have our cycle high here. This is back in August. Fibonacci to our cycle low here in October. Perfect 50% retracement right here. Former support right here. Now resistance. We got a bearish candle yesterday. And then look what happened today. Look at this big red ugly right here, which broke the upward trend line. That, Dan, is about as bad as it could look. I don't know. I couldn't draw you a chart that looked worse than this. So I do want to, put the warning shot out there for people. Like, expect things to not be so bueno. in the financial markets over the course of the next year. Now, anything could happen, but be prepared. Just kind of understand, like, all these charts, and I could show you more. They look terrible, absolutely terrible.
You
And
know
that's
what
just
Biden would say to that?
what is he?
Oh, man.
Now we're gonna have a button conversation.
We need to get real good at these, so yeah, we could just throw them in there all the time.
Let's look at some hardcore just data here, just some real estate data. Like, I'm gonna take my opinion and put it in my pocket for a second, and let's just look and see what this is telling us. Now, this Altos research, strong data from here. I constantly using the same one because I always want to reference the same data place when you look at this stuff. Now, the market action index is still showing a strong seller's market. I'm going to go ahead and disagree.
Yeah.
I would not call this a strong seller's market. I would call this sort of textbook buyer's market. And what I mean by textbook buyer's market is usually when it's a buyer's market, it's because buyers have scattered. In other words, buyers are not understanding that it's a buyer's market, and that's why it's become a buyer's market.
Sure.
And so this is a very textbook buyer's market. I remember right after the crash, this is maybe 2009 or 2010, somewhere in there, Dan, when I was talking to agents and they would say, hey, I have 12 listings. I can't find a buyer. Buyers were just nowhere. And prices at that point, literally you would still be tripled if you had bought at that time versus where we are today. I mean, prices were so low. It was crazy. It's the most amazing time to buy real estate since I've been in San Diego, which is now 17 years.
Shit, we even just heard Dave Ramsey say something just along those lines. He never says anything good about real estate. He just said that now is the best time to buy real estate.
It's a great time to take a look. It's definitely a great time to take a look and pay close attention to the price you're paying. Obviously, don't get yourself in a pickle with the payment.
Yeah.
But pay close attention to the price you're paying. We're definitely a payment nation, so that matters. But pay close attention to the price you're paying. So median list price, 1.1499. 1.1499. Now, saying the market action index is 48, was 48 last month. That's the first thing I noticed was, okay, that seems to stabilize a little bit. We'll take a look at some of these averages here in a second and what some of these different profiles are showing us. Price per square foot has been on a decline here. I'm going to look at a bigger graph on that. Average days on market has been increasing. These things all make perfect sense. You're seeing a lot more price reductions, 53%. Yeah. 53% of listings with a price reduction.
Is this San Diego County or city?
I believe it's city.
Okay. So that makes sense because I think the stat I was looking at today was 46%. But still, yeah, around 50% of homes are having to decrease their price. And that could also be part of the strategy. I just saw a meme today I thought was hilarious. It's like sellers still think it's 2021 when we have this crazy seller's market, and buyers think that it's 2008, as in they think the market's going to crash. And that we're running into a lot of that, and that's why it can be hard to come to negotiations with some people, but it can be part of the strategy for some sellers and listing agents of like, all right, well, I know you want this price, so let's just plan to have it on the market for a week. If nothing happens in that first week, we don't get the activity we want, then we'll like pretty quickly lower the price so that we're not feeling really stale when we're 2, 3, 4 weeks in and make that initial price reduction. So some of it is that as well.
Yeah. I got to tell you, I don't like that strategy one bit. I mean, I know sometimes you have to do what you have to do.
Yeah.
But yeah, you're what you're seeing is, buyers believe not. And here's what's really interesting. Not only do buyers believe that we're in 2008, they think it's going to continue to get much, much worse. A lot of buyers now saying, oh yeah, I think prices are going to drop 20, 25% from right now. Prices have already dropped quite a bit. I mean, you're telling me, I just don't know where you would find sellers who would want to sell their homes for that low. Like, I think that's the big issue. But needless to say, almost 25% of the homes here relisted. Inventory, though, look at that, sort of creeping lower. We're going to look at this on a bigger scale too. Rents, very stable, but the market action index here has been declining, but seems to be rounding out And that's usually a really good sign, a bottoming sign is when something is
Mhm.
rounding out. So there's not a lot of velocity in that decline now. The velocity has really, really decreased and it seems to be rounding itself out. That's a really good bottom formation. So let's take a look at
Can I
this is
ask
my
you an opinion question real quick?
yeah.
So, we hear a lot about, from various people, and usually it's the people that I don't know the best way to do it. The people that are just out there screaming that don't really have a background of economics or anything to do with real estate that are saying the market's going to crash. And I'm curious, like, let's like take a step back. What does a market crashing mean? I think historically it's like you'd say somewhere between, oh, there we go. It's somewhere between like a 10 and 20% reduction in prices. Is that what you would say consider a crash?
So if we go back here, let's say Fred. Let's just look. Let's look at what happened to the average home price during the actual crash.
And what I'm getting at here is if prices came down 10%, I think on paper we'd all say that's significant. But at the same time, that's only going back 6 months. Home values increased 20% from 2020 to 2021. I'm sorry, actually 2020 and 2021 and 2021 to 2022. Both years we saw a 20% increase about for median price home. So like in my mind, it's almost like you'd have to go back to where home prices were a couple of years ago. And you're talking a 40% reduction in home prices. I mean, that would be crazy.
Well, take a look here. Let's so 322 100 by 322 100. So top to bottom, the '08 crash on average was a
And this is for
20%
the
decline.
US.
Yeah, this is United States. We went from 322 to 257. So 257
Yeah. How far back was that
divided
to
by
get back
320.
to 257?
Yeah, it's 20%. It's a 20% decrease. So on average, so there's average
Yeah.
across the nation. Obviously, there was areas that were affected more than this. There's areas that went down more
Sure.
than this. There's areas that didn't go down this much, but it was top to bottom 20%. And this was literally the worst case possible scenario imaginable. Fed was nowhere to be found for a long time here. They did not save the day right away. It was bad. Okay. Really couldn't have been worse. Mortgage fraud was rampant. Terrible, horrible, horrible things were going on. And we lost 20%. So if we are down now, let's say 10% or so, even 12% in San Diego, that is got to represent a big chunk of what it's going to be. Maybe it's not all of it. Maybe there is still some downside in there, but to think that there's going to be another 20 or another, big chunk, another big leg down, we need to have some other piece of information beyond just higher rates. We'd have to have,
Yeah.
oh, well, there's this fraud that's been going on that no one knew about, or,
Mhm.
this over here is broken somehow and no one saw that coming. You would need some sort of new piece of information that was significant and really bad, that would have to factor in to this
To bring
equation
more homes on the market.
right at lower prices.
Yeah.
And that's the hard part with that. But this right here, so this is average price per square foot. This is my favorite metric to look at because this really tells you, what the movement looks like, in the marketplace of what people are willing to pay. And we did see, so, if you just sort of average this out, we sort of peaked out at 600 or 700, now down more closer to 650. So what does that give us? So 650 by 700. So that would tell us that the market overall is down on average about 7%, a little over 7%. Let's call it 8% in San Diego. And just from a price per square foot perspective. So could there be another 8% leg down? Could there be, more than that? It's possible, but it becomes less and less likely. The more the market goes down, the closer you are to the bottom always.
Mhm.
So it would seem to me, that this could go down a little bit further. But I think you're going to see, if we get down too much further than this, like if we lose another $50 a foot, you're just going to have buyers come out of the absolute woodwork at that stage. So we're not at that point yet, but it's in there. There's definitely people there.
And
Here's
we can, we're not just, you're not just saying that because you're making an assumption that there are buyers out of the woodworks. We've been talking to plenty of people over the last 6 to 12 months that we know, we can see them sitting on the sideline saying, we're just waiting for prices to come down a little bit more. And so if that happens, they're going to be ready.
dozens and dozens and dozens of people pre-approved, want to pull trigger, don't like where things are now. What is going to happen for those folks is one or two things. If you're one of those people, here's what's going to happen for you. Either you're going to be right and you'll get a great deal in the next year or something like that, or you'll be wrong and you'll be FOMOing in later and you'll be part of the run-up, the next move higher. It's one of the two. It's one of those two situations is what's going to happen. I don't know which one it's going to be. Nobody does, but that's what's going on. So this still looks pretty strong. Obviously, the trend is broken, but still in a very healthy spot from just an overall standpoint. Let's see here. Let me get rid of this, create a little more space. There we go. One-man show here. I'm getting better. Let's see. Inventory. That was the other one. Okay. So inventories come up. No question. No question about it. Especially, from the lows down here in March. Between December and March, we had very low inventory, and it has ticked up for sure. But this chart is a 3-year chart, and you can see going back 3 years, this isn't the highest that we've been, even just going back 3 years. Pre-COVID, we had higher inventory than we do now. And we know what happened, during COVID and all this time frame. There was a frenzy which pushed this inventory number down, an absolute frenzy, which caused sellers to come out of the woodworks, right? I mean, I talked to several people who are good friends of mine that were like, a realtor came and knocked on my door one day, said, hey, I can get this much for your house. I said, hey, you're crazy. If you can get that much, I'll sell it. And they did. I mean, that's how crazy it was. So that's what it took to get inventory down to these levels. People literally naming prices that were absurd, and they were getting it. And so now I'd say this is probably a lot more normal place for us to be. It's not a spot where sellers are really motivated to sell because they're getting to dictate all the terms, but prices are still pretty good. So if you need to sell your home, you can do it, and you can, do a good job about it, and you can still get a good price. It's kind of in that limbo phase where it's not a great seller's market by any means. It's not a great buyer's market. It wouldn't be a buyer's market though, guys. I'm telling you, if rates were 3%, it just wouldn't be. We'd be in the same boat we've been in. It would be bananas. So what comes with the buyer's market is sort of conditions that aren't ideal for buyers. And that's why buyers are stepping back, and you're seeing opportunities for the people who are stepping forward.
Now, is it possible to change this to anything more than 3 years or no?
No, there isn't actually. Okay. Not in this format. They only go back 3 years. I've tried to do that myself a few different times. They have these different segments. But yeah, it's basically just a 3-year chart.
So 2 things. One, just look at what's happening at the very far right of that chart. It's rounding off.
True.
If we were really seeing this massive decrease in prices, that would not be rounding off. Inventory would continue to rise. Now demand is down a lot. It's definitely down a lot. So that's why we're seeing prices still slowly, methodically coming down. If you were to extrapolate this out the previous 3 years, what you'd see, and now these are the numbers for the city of San Diego, but as far as the numbers for the county, you're looking at around 4,500 homes for sale right now. So that would be the far right of the graph. And this basically, the whole chart is essentially throughout COVID times. This is what we've seen inventory, and it was historically low this whole time. If you were to go back another 3 years, you'd go from the 4,500 homes that we have for sale right now to the average for the 3 years before that was closer to 7,000 homes. So it was like 6,800 homes is the average for the 3-year span before this. And majority of that time we were in a seller's market. So in order for like what we need here in San Diego, we say this over and over and over again. We need more homes for sale for there to be a drastic change. And we're talking like over the long term. And we're nowhere near that.
Yeah. It's going to be hard to entice sellers to come out and list their homes. Unless they're in a situation where they need to, or people are still upgrading and downgrading. And listen, if you're selling and buying in the same market, then the good news is, I mean, no matter what the market is in that situation, you're selling, you're buying, you're going to win on one side and lose on the other, or whatever, I mean, that's just the way it is. Like right now, if you're selling and buying, you're probably not going to get as much for your sell as you were hoping, or as you could have a year ago, but you're also not going to pay as much on your purchase. And so you're going to have to kind of, that's the give and take. You'll make it up one place, you'll lose it another. It's really only if you were just selling and you had nothing else going, so you're able to rent. You believe the market's going to crash, another 20%, you're just going to sell and you're going to go rent for a year. I believe me, people are telling me this. I mean, it's bizarre as it sounds. If you're in that situation, yeah, you're going to look at it and go, man, this isn't a great time to sell. But will it be better than tomorrow? It could be. Will tomorrow be a better day to sell? It could be. We don't know. All we know is right now, we haven't seen anything that resembles necessarily a crash, but the sentiment is already there. The sentiment of a crash is already with us. So like if we were going to see these huge declines, borrowing any new information, if we're going to see these huge declines, we probably would have already seen them. But what we've seen is that sellers aren't in a spot where they have to sell. They don't have to fire sell their homes. They don't feel like, oh, well, I've got to sell this house now. I've got to get out of here. That's just not happening, at least not from what I've seen.
Yeah. And Philip is saying, unless your tax base increases dramatically. And you know what? That's what people have been dealing with over the last 2.5 years is you're buying a more expensive house. Your tax rate is going to increase. And that's just something that you have to deal with when you're buying a home here. It all goes into the same calculation of what you can afford. And it hasn't really slowed people down from buying, except for the fact that now the mortgage interest rates are up, and that is slowing demand a little bit, but it's the mortgage interest rates that are slowing demand and not the increase in property taxes.
Yeah, it is. And what's interesting about that, and we always say, like, yes, it's totally true that we can't guarantee you'll be able to refinance down the road, but it is something, it is a piece of upside that you have in the equation. So, if you're buying a house today for, let's say, $50,000 or $75,000 less, maybe even $100,000 less than you would have a year ago, that money that you're saving on the purchase price, that's permanent. So purchase prices are permanent. Interest rates are transitory, meaning that, you can change it. If the opportunity presents itself to improve that, you can change that. You can't change your purchase price. So all in all, when you look at the investment in real estate, what you're really the most important number is the purchase price. That's the real most important number from an investment standpoint. However, if people don't like the payment, they will not pull the trigger.
Yeah,
they won't. They just won't. And that is where the standoff is right now. People are cool. They're okay with the price. They're saying, okay, hey, they're asking that much for that. Okay, that sounds good. That sounds reasonable. How much does it cost me per month? I hate that number. Why would you show me that?
Yeah.
and that's where it kind of ends. So this is hence where the opportunity is. It's difficult. Everyone wants a bloodbath because they say, oh, when the bloodbath comes, I'll dive in. I know that's the time to buy. I know to do it. But when it comes, it's hard. It's hard because there's always some risk. There's always some, possibility you're making the wrong decision. There's always something right there. Someone in your ear, the news, this, whatever. There's always something that makes it difficult to pull the trigger when it's the right time to actually do it. And so I think that's what we're battling right now, personally. But I don't think it's a bad time to buy a home. I think it's a better time to buy a home than it was a year ago. It's a better time to buy a home than it was 2 years ago. But people don't feel that way because of the payment.
It is in a lot of ways. And I know, like Philip said about the property taxes, absolutely something to consider. But at the same time, if you look at the chart of real estate over time, it does this. Like, yes, there are peaks and valleys. It goes up and down. But, I can't guarantee anything in real estate, but I could basically guarantee in 10 years, your home value is going to be probably pretty significantly more than it is today. And the benefit of living in California is when you buy a home with a property tax and it's going to be reassessed based on the purchase price, you're basically going to be locked into that price. I mean, it could go up a small amount every single year, but it's not like Austin, Texas, where they get reassessments every single year. And when home prices went up 20%, so did their property tax. That doesn't happen here in California. So we're in this really great situation where if at some point over the next 10 years you need to make a move and you're worried about property taxes, well, guess what? They're going to get worse over time. And if you make the move now and get used to that payment, then it's only going to slowly go up a couple of percentage points every single year, as opposed to the 5 or 7 or 10% that home prices could increase.
Yeah, and you look at you were talking about what the graph does, the real estate graph does. This is it right here. It goes up and to the right. That's always going to be the case. When you pick the perfect spot to get in, let me tell you something. Right here in 2008, when foreclosures were crazy at the bottom right here, that was bloody, bloody, bloody. The Dow Jones was around 6,500 at this point in time. I'll never forget this because Barack Obama had just become president, and they were talking to him, and he said, "Oh, wow, is the stock market down that much? Probably a good time to buy." And he was perfectly correct. He called the bottom. I think everyone was like, "Wait a minute, he's right." And they just started moving in the right direction. I'll never forget that, but it was terrible, horrible. No one wanted to have anything to do with it.
Yeah.
That's what bottoms look like, guys.
That's an interesting thought for sure. Like when you actually think about not just what things look like on paper, but the emotions that are going on by the prospective buyers and sellers. And you're absolutely right. You're absolutely right.
Let's do this too. I got one more preload here. I'm learning from you, Dan, by the way. So I'm
Nice.
Getting better thanks to you. I learned by watching you.
We help you in the amount that you've taught me when it comes to rates and bonds and all those things. I mean, it's great.
Fair trade. So here you see the average rate right now in the US, 7.08%. So that factors in everything. The question is, when will rates go down? Right. This is the question that I'm getting all the time. You see here that we had this beautiful channel just going lower rates right here, just all the way from the mid 80s until let's see, we really bottomed out in 2021 or 2020 right there. But let's zoom this in here. Zoom this in and get a look at what we're actually seeing right now. So what we're seeing right now is we saw rates kind of dip lower here. This is December 2020, January 2021. The average rate was 2.66, 2.65%. That's what the average rate. How crazy is that?
Nice,
And then, since then, we've seen a couple of legs higher. Now, I thought this might have been the turning point right here. Remember in June, we said, hey, that inflation report in July is going to come in. It's going to come in nice and clean. That should help bonds rally. That should help rates dip. And it did.
I remember you saying that on my channel.
You remember that?
Yeah, I do.
It did. Rates came down to an average of 4.99. But since then, thank you to Goldman Sachs and their bond trading desk, we've seen bonds just get annihilated every which way until we get to this point now here. We're at 7.08%. So I do think
I was just going to say, right after that is right when Jerome Powell came on and said that he's basically trying to crash the housing market.
Yeah, he needs a little bit of coaching in how he approaches some of these things. But I do think it's entirely possible that we could revisit this whole area right here, which is essentially 5 to 5.75%. And that would be and I think we could get there relatively soon. I'm going to say within 3 to 6 months, we could be back in this area, this range. Very reasonable to expect that. Very, very reasonable, especially if you start to see anything from Fed about turning things around. We revisit this area, and it's a total game changer. Listen, all the deals, all the things that are going on right now, buyers. I just had a buyer got in contract, Dan, 60-day escrow, which they requested. The buyer requested 60-day escrow. 25,000 in seller credits.
Okay.
To buy the rate down, 2-1 buy down, and to also pay for their closing costs. Okay. They dictated everything. Team, if rates get down to here again, even the top end of this range, that's not happening anymore.
Yeah.
It's not happening. Won't happen. So are we for sure going to come down these rates? I don't know. I think so. I do believe so. I would bet on it, but it doesn't mean we have to. But if we do, I just want you to know how close we are to being right back to a market where you're, as a buyer, you're not getting all these things anymore. It's not that far away. Rates in the 5s would be a game changer on so many fronts, especially with the 2-1 buy down already out and about. A lot of banks rolling that out who didn't have it. Not every bank has the 2-1 buy down, but now they're picking it up. You put yourself in a situation where rates you're getting a 5.75. Oh, now you're getting a 3.75 on your first year with your 2-1 buy down. That is a game changer in what payments look like, what people will be willing to pay. It would completely change the game. And that's all we need. We need like 1.25% off of mortgage rates on average, and we're right back into a frenzy. So it's much closer to that than I think a lot of people realize. And you continue to see, these numbers that come out regarding the economy as far as payrolls are concerned, as far as jobs are concerned. The average increase, by the way, on these, let's see, do we still have this pulled up? I had this up earlier. My bad.
And do you think is it safe to say that rates will continue to go up before they start to come down?
Right now, we're in a fragile moment, my friend. This is a fragile moment because we have not really bounced much. There hasn't been a huge bounce in bonds. There was a little bit here in the lead up, to this week. So last week we had some nice action here, a very nice channel that looked like really good, especially once we got that bullish engulfing candle. It was like, okay, this is going to tell me everything. If the next day, if we print another one, then we're off to the races. But we didn't. And we got stopped at the 25-day moving average, which we had just closed through the previous day. So that was kind of an indication that, wait a minute, market's saying, hold up. We're not going to keep moving at this pace. Not right now. And that's the reason why we're in this situation here, where we're just sort of bouncing between this neckline of support and this 25-day moving average. Something's going to have to give. I do think it's entirely possible that rates could get worse in the short term. It's entirely possible. There's a ton of pressure. But also at some point, bond investors, and I'm hearing more and more of these big bond investors chirping that bonds are starting to look attractive. Bonds are starting to look attractive. Bonds are starting to look attractive. I keep hearing them chirping that. Well, guys, get in there, will you? Will you get in there and start trigger pulling? I mean, seriously, it's great. It's terrific that you are saying this, but get in there and push the buy button. Come on. That's what we need. We need big bond buyers, Dan. We need big bond buyers. This is usually going to be funds, so you're talking about, mutual funds, hedge funds, pension funds, these kinds of people. We need those people to start piling into bonds. And I think that there's a much greater likelihood of that taking place if it becomes more of a bear market in stocks. And
Sure.
that's the silver lining. I don't want to see anyone's accounts go down. But truth be told, this is a terrible, terrible look right here. What's going on? This is the S&P 500. This is a really ugly candle right here coming out of this trend line. A huge rejection today off of what the Fed did and what they said. And so if the stock market gets really red, there's two possibilities. If it's a system-wide capitulation, so in other words, let's say it gets really red really fast, too much velocity, then what can happen is some of those funds will actually have to sell their bonds in order to pay margin calls and to cover other things, cash redemptions. People will pull their money out of the funds if they see the funds going down, and in order to pay those people, they'll have to sell their bonds. So if it happens too fast, it can sort of system-wide capitulate and cause problems across the board. If it happens relatively slowly, just sort of we drift lower. We have a bad day, then we have a good day, then we have a bad day, then we have an okay day, and then we have a bad day. We just kind of drift lower. Then you can see more money flowing into bonds as those fund managers realize, okay, we actually need to be exiting stocks and putting our money into these safer returns on investment. If that happens, then you can start to see some big bond purchases take place, and we can see this thing rocket higher. And that's really what we're That's what we're needing. That's what we're missing. And all we need, if you look at this chart right here, just to play out the scenario I was telling you earlier, a percent and a quarter would be 375 basis points. So that would put us up at about 102. So about right here. Mortgage bonds get to right here, right there. And this market we're in right now, where buyers are ruling the roost, is over.
Sure.
Over. And that's it. So it's from there to there. that's the distance between buyers get whatever they ask for and we're back to multiple offers on every property. It's that close. So I just want to make sure everybody knows that while you're hearing a lot of things where they're constantly saying things about 2008 and blah, 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 the market's not great. It's not running away. There's nothing. That's not crazy at the moment. There's lots of fear. There's all sorts of things like that. But it is not that far away from being able to turn around and all of a sudden we're back at it. And it's a frenzy, and you and I won't even have time to talk to one another probably, unless it's regarding a deal. That's how close we are. We're 375 basis points in bonds away, which means we need 2 or 3, big bond buyers, and that's it. And we could be there in a matter of a couple of weeks. So we're not as far away from things being really good as people think. I think we're much further away from that really bad crash scenario where there's some new fraud or some new thing that we learn of. Oh, we didn't realize that these big funds were doing this and taking these risks, and that's now starting to capitulate. And we haven't seen anything like that. And until we do, I'll still remain, firmly bullish that it makes sense to look at real estate, especially in a market that's softer for sellers.
Yep, absolutely.
Okay, my man. Final thoughts, Dan. What's your best advice? Let me get some advice from you here. Let me get a seller tip from you in this market and a buyer tip.
Oh, I like that. Oh man. Seller tip and buyer tip. So, as far as seller tips, if you want to, depending on your situation, the two things people are usually looking for are terms and price. If you want to get terms and price, if you have a certain timeline for when you want to sell the house, you don't want it sitting on the market for a long period of time. You just need a really strategic plan that's more than putting a sign in the ground. And there are a lot of agents out there that claim to do a lot of things like, I was just talking to someone today. It's like, oh, we're going to syndicate your property to 10,000 different websites so that you have maximum exposure. Well, it sounds really cool and fun, but that means they're just hitting the bare minimum requirement that is put forth in that listing agreement, that they're going to add your listing to the MLS, and then it automatically syndicates all these websites. So all that to say, just have a plan in place, a really strategic plan. I know that we see prices on Zillow and Redfin. They're all over the place right now. You really need to do a hard look at what homes are selling for in your neighborhood. And then you need to come up with a strategic plan, which has to do with price, which has to do with timing, which has to do with marketing, that's going to put your property in front of the right potential buyers so that you are running the show and they're not running the show by asking for the $26,000 credits in the 60-day escrow that Derrick was just talking about. So yeah, just being really strategic with how you're going to list your home is very important. On the buying side, I think the buyers that are the strongest in this market right now are the ones that have time. And that doesn't mean that you should wait. I get people ask me every single day, Dan, should I wait to buy a house? Should I wait 3 months? Should I wait 6 months? And my advice isn't to wait or not to wait. It's actively look in this market, be ready to hop on something if an opportunity pops up. And that's exactly what I'm doing. I'm looking to buy a house right now. I'm probably not going to have one under contract by this weekend, but we're slowly looking. And my kind of loose goal is over the next 3 to 4 months, we're just looking at the properties that are the most enticing to us. And we're seeing if we can get maybe not like a crazy deal, but get it at the right price. It's something that makes sense. Because inventory is not like this. We're talking about this the entire time. It's not like you have a whole bunch of properties to choose from. It's pretty limited on what you can choose from. So if you have the capacity to take your time a little bit, and if rates continue to go up a little bit, it's not going to keep you from competing altogether. Have the opportunity to slowly look over the next couple of months and take some strategic offers out there.
Man, great advice, especially heading into the holiday season.
Yeah.
Totally didn't even think about that. But yeah, what an opportunity to hawk the market. So I always say is just hawk the market, meaning get yourself pre-approved, be in a position to pull the trigger if you see something great, and know that you don't have to do anything.
Yeah.
Wait till you
Be
find
re-
something that speaks to you.
be realistic on what you can get in your price point. Know that you're not going to get something, 30, 40% undervalued, as we've been saying this entire time. But when the right opportunity pops up, and sometimes you just know it's the right opportunity, you go for it.
That's right. Be ready to pull the trigger. Dan Parker, thank you so much, brother, for being here. Best Life Home Team. I'll put a link to Dan's channel in the description below. Check it out. Tons of great information on San Diego real estate. We really appreciate your time, brother.
Thanks, Derrick. Have a good one, man. Let's do it again soon.
We will do it again soon. Guys, share this with your friends. Let's help make them smarter than everyone else, and I'll see you soon.